Good to be here. I don't even know if I need this mic, but good to be here. Let me start off by just one thing. On my next slide where I talk about my background, I wanted to say it up front. I'm an Aggie. So just letting you guys know. So I don't know if I get extra credit for an Aggie presenting to Longhorns, but it's good to be here. How many have startups? Okay. How many are thinking about a startup? Fantastic. So let me tell you a little bit about myself, and we'll get into how we'll talk about startups and what the importance of the financial modeling part of startups. You can see my background here. I'm finance and operation heavy, which for what we do in my company is good. So over 20 years in public and private organizations, variety of big corporate experience, and big transaction experience. I was part of the team. I've done 2 IPOs, 2 leveraged buyouts, large leveraged buyouts, the biggest ones here in town. So I worked with the team at Dell on theirs, worked with Freescale on theirs. Good stuff. CPA, CIA. So, I feel pretty confident about, or at least let me say it this way, I felt really confident about numbers and modeling, but as you are working startups, it's a very different environment. It's a very different environment. We'll talk a bit about that as we get into the discussion today. Please, let's make it interactive. I think that's important, so if you see something and have a question, raise your hand and stop me. And also, this is, I'll say it up front, this is probably a little bit of art and science. I didn't include a lot of financial spreadsheet kind of material in here. I figured we can understand just a little bit of the art, if you will, behind modeling and the importance of it, and how you want to think about conceptually how you want to build your model and the importance of it and the questions it will answer. And then if we need time to, on a future visit, I can talk more specifically about modeling specifics. Does that work? Okay. Let me first also tell you a bit about the company. My company, what we do, we work with venture capital and private equity firms. We go into those companies and mostly I become the CFO of various companies in those portfolios. So kind of leveraging a lot of the corporate background and experience where I was the CFO of various business units and also working with some of the corporate teams on different activities, taking that into the private sector, which is very exciting. And again, very different dynamic when you're talking about what the VCs, in particular, what they're looking for in models. And the other part is, for example, I have one company right now, we're going through an acquisition, and it's a strategic that's interested. But, we've been in contact now, I think, with 4 other private equity before we get into the exclusivity period that are very interested. So the model has become, for this particular client, a tool that, again, it drives a lot of the discussion with those various investors. So we'll get into that more. What do we want to talk about today? Why is the financial model important? I think people probably, I don't know how deep people think about it, but I think it's an important part of the startup process. Again, in my experience, a lot of the entrepreneurs that I work with, they are fantastic at whatever it is they do, whatever it is they are an expert at. If they're a doctor, they're fantastic at being a doctor. If they are an engineer, they are great at being an engineer. So I run the gamut with the spectrum of what I see in terms of the knowledge base. A lot of times where it falls short, though, is on the financial and business acumen. I've come into some companies that have gone through a round or 2. They did not understand their term sheet, and so that became a problem. I've gone into some where they really didn't have a model. They had some QuickBook financials, and which is all kind of backwards looking, but there was nothing forward looking. Still got investment, so that's another session we probably should talk about, how they got the money. But they don't have a model. And then they're trying to go out and get more funding. And it's a subsequent round of funding that they're trying to go get. So again, there needs to be a little bit of thought as you think about your venture. What is the importance of your model? What will it be used for? Know your numbers. I believe everybody in the room probably, again, takes that for granted, but you would be surprised about what the aspects of the numbers that folks don't know, don't think about, so we'll get into a little bit of that. Understand the impact of your model. You've done all this stuff. Now, what does it really mean? What is it saying? What's your story? How are you going to pitch that? So we'll talk a bit about that. If you do anything, if you forget all the other stuff, you better remember cash is king, right? If you are living if you're doing this on your own, whatever your case is, if you don't know your runway on your cash, that's a problem. I think I've seen again cases where I get around to funding, I'm funded, it's great, go have a party, it's all good. Everybody in the office is excited. Fast forward 12, 13, 15 months later, however long in the future it is, and hey, Shawn, we got to make payroll this week. How are we going to do that? We should have, we probably should have engaged with each other 4 or 6 months ago or 15 months ago when you originally had the funding, right? So those kinds of questions, they come up. Again, I'm sure I'm with a bright crowd who will do better than that. But again, I think we got to think through those steps as you build your model and think about your business, whatever it is you're going to do. So, what is the model? It's a mathematical, financial representation of your business. That's simple, right? It is, if you've created and if you've documented what your business plan is, it's the math representation of that business plan. And I think that if you create a business plan, which you all should do, the ones that are starting a business or have started one, create the business plan. Lay out step by step by step what your business is. Again, having a great idea, as many of you know, is not enough. You've got to really understand, what market am I going after? What are the metrics around that market? We'll get into that a little bit on the know your numbers, but you've got to think about that market, and then think about, again, if it's something new, you've got to understand, well, that means you're creating a market. So what are the dynamics around that? If you're going into competition in a market that already exists, you got to understand what the competition is. How much share are you going to get? What's the growth rate on the share? How are you going to differentiate your product or service to go solve that problem? The model is the financial or mathematical answer to those questions. Okay? So in its basics, that's what it is. It's the math model of the business. I've just kind of talked about why it's important for you as an entrepreneur to understand those things, and we'll get more into that also on the numbers. But it's important for investors as well, right? I mean, ultimately, your goal is to go get funded. And unless you've got deep pockets and you can fund yourself, and whoever that is in the room, meet me afterwards and we can talk about that. Got some companies that may be interested in your investment, but unless you've got personal deep pockets, your goal is to go out, go find angel funders, go find VCs. Ultimately, if you do well, get private equity involved maybe. Not a lot of people are going public nowadays. That's not as cool as it once was, but again, that's the ultimate goal, is to go get funded. So you've got to have a story for the professionals, by the way, right? Because that's all they do. right? The good PE firms, they look at, you guys probably know the numbers better than me. It's probably what, 2, 3, 4,000. They kind of weed through those kinds of cases a year, weed that out, and they might get down to, you know, depending upon the size of what they're putting their money into, 10 investments in a year. So think about that competition. Your story's got to be solid. So they want to understand the business. They've got to know because they're taking, in the case of VC and private equity, they're taking somebody else's money and giving it to you. So number one, they really need to know the business, right? What kind of return are they going to get? How do they think about risk around this investment? The model is the story for a lot of that. And then the who. Who are you? I'm about to give you $5, 10, 15, $20 million. I need to be pretty confident that you know what you're doing. So again, if I invest, if I have a portfolio and we invest in, you know, medical, I have several clients in Houston and we got a lot of medical activity. There's a lot of medical money happening right now. But again, when we get ready for pitches, the doctors don't necessarily understand the importance of the model, and that's where we work with them. Some questions on why the model is important. What kinds of questions will the model answer? Right? How many people are you going to hire? What kind of salaries are you going to offer the folks? Trying to get top-notch people. If you're here in the Austin area, you're trying to get programmers. You got to have some real good packages. So you're going to pay a lot for that, or do I need to go offshore and find a site in another low-cost area and get a team there? Costs money to fly and get that and build that team up. Now, who do I hire to go supervise that if I go that route? So a lot of detailed questions you need to get into because that's where the conversation is going to go. Again, that $20 million check is going to go and fund all this activity. And you as the entrepreneur, you got to know the game plan. Rent, again, Austin, very high rent. I've got a client right now if anybody's looking for some space, we got some space off of 360 that we can sublease. So let me know on that one also. When will I make the money? Where's my break even? Right? That last one I think is an important one. How much money am I going to give you? How much money am I comfortable in giving you? You know, we've talked for 45 minutes. I've seen your model. I've kind of pressure tested some things. I don't know. I need to go back and talk to my partners and see if I'm confident that, you know, this is the right play, right? So that's kind of the conversation tool for what the model is used for. Okay? Any thoughts or questions on that? Quiet crowd. All right. Maybe I'll get you going on this next one. Lots and lots of numbers, right? And I put that on there in the deck because, again, my experience in dealing with some of the entrepreneurs has been some of them, again, maybe not this crowd, they're not comfortable with the numbers, especially the amount of numbers. I think, again, there comes a line of, well, Shawn, how much do we really need to know that? Do we need to go there? You kind of do. You've got to kind of play this thing out where you're asking yourself a range of possible questions that you think you're going to get asked that you need to answer. The assumptions in the modeling need to be extremely clear. There needs to be a tab in your Excel sheet that is your list of assumptions. Okay? You know, I'm assuming if I'm making a product, how much my cost of goods sold for the product is. Why do I think that? There'll be a question around that. Maybe if you partner with somebody, can you get that cost down? If you manufactured in one place versus another, have you thought about that? No. Well, your margins look soft for that space. Why haven't you thought about that? Everybody in that space, they're running at 40% margins. You're at 35. What's the deal there? You want to know those answers going into any kinds of discussions. You want to be thinking about that part. I have a list here of just not only acronyms like ASPs, but just the things, again, that you need to be thinking about. Of course, what's your revenue? But then before you even get to revenue, how many widgets of X are you going to sell? What's your average sales price, ASP? How do you know that's a good ASP? The assumption that you create needs to be pretty clear. Again, if it's new, you need to have a rational thought process behind why you believe the market is going to accept that price, right? Versus if it's a new product that's not in competition, you know, how does the market? How do you think? What's your range? What's the value prop that you believe is justifiable for the price you're going to charge? If you're in competition, that's different. That's pretty easy. The market typically will take a certain price. So again, you've got to really dig into that and understand that. I think this is probably a space that, depending upon where you are in the maturity cycle of the startup, if you've been out there and you've been selling and you've got a feel for the market, very easy to answer that. If not, this is a place where, when I'm working with a lot of the clients, let's just put a number here. Let's get a range, and we'll build off of that. We'll go back. But that's one of those, you got homework to go do. You've really got some homework to go figure out who's a potential customer or 5 customers. Talk to them. They need to be on the hook. They need to give you a sense of, I'll buy it for that, but not for that. So there's homework that really goes into knowing a lot of this activity. Yes, great question. The internet is a fantastic tool. I'd start, if I'm you and I'm not used to a lot of the numbers, there's a lot of freeware out there where you can go and you can get free Excel sheets that kind of have a model in place. That's one place. There's a place to go get the tools to actually put the numbers into the spreadsheet. The other part, though, and it was my last bullet on the overview, it's really about asking for help. So, you know, one thing at the end, I've got some contact information, but you know, I would say if you're non-financial, find a friend that's financial and connect with them, right? And just have somebody, you'll be surprised in what a 30-minute conversation of, hey, I'm thinking about something, just listen to me and walk me through this, what that does. For a lot of my clients, that's where we are. It's just, Shawn, I had a business trip and a deal's going, you know, we talk about structure on the phone. Well, are you thinking about a JV or, and again, find somebody that you can use as a resource. Entrepreneurs, the one thing that I've seen in the successful folks that I work with, they've got a great network. Great network. So utilize your network. If you don't have the network, build it. And again, if you're an entrepreneur, you're going to get used to leaning forward and asking people for all kinds of help. So if that's not your strength, again, if you're going out to go start a business, you need to make that one probably a top priority of getting used to. Okay? Thank you. Any other questions? Yes. Common assumptions that I generally see. I'll maybe go another step and say common assumptions that I would suggest that you have at a minimum. I think you've got to have market assumptions, number one. What is the TAM? Everybody know what TAM is, total available market. What is your SAM into that TAM, sellable available market? You need to constrain your market, whatever that is. For whatever your widget is, whatever your solution, you need to constrain your market. My market size today is, $10 billion. There's 10 billion things that are floating out there. Very few people have such a new idea that they can say, well, there's not a market that this really exists. That's, for a VC or an investor, that's really going to be hard for me to get my head wrapped around. So hold that thought. I would say there's markets, and then I would say the ASPs. How do you fit in that market? How does your product price fit in the market? Okay. It'd be really, I think, really key is to understand the growth in your market. I had one client, had a great portfolio, so they thought. When we pulled the market data, they had invested their whole portfolio, about $20 million, into a declining space. Kind of hard to get new money when they're seeing that space is going down. Why didn't you know that? So know the market, know the trajectory of where that market's going, then put your product into that framework. What's my price? How many units do I believe I can sell? So build you a simple unit table, right? October through December, I'm going to sell 1. Then next month I'll sell 3. Then next month I'll sell 5. Put your price on that. And it's that simple. Units times price gives you a revenue number. So walk down the P&L. Walk down the income statement. That's a great place to start in terms of assumptions. Who knows how many accounting or finance, who's comfortable with financial statements in the room? Before I start, put your hands up, because I kind of not. Okay, so if I throw out an acronym or a term like P&L, stop me and ask me, well, what does that mean? It's a profit and loss statement. It's also called the income statement. Okay, and don't get nerved up about that. That's okay if you don't know that. Okay, yes, sir. Oh, that's a good question. So I don't know if everybody heard it. The question was, once you've built your model, how do you change it after you've established it? I think the key is to understand your assumptions page and put versions of what your assumptions are. So you've got assumptions page V1 of what you initially said. Now you've got V2 because you've learned more and you're smarter. And, I've had it where, you had to push sales out because you thought you could sell it October, November, December, like I said earlier. But the reality is now I've learned I'm not going to sell it until February of next year. The model needs to become your truth. So that needs to become your truth. Now, when we get into later discussions about how we talk about the model, we can talk about how we talk about that truth, okay? Especially if you've already started to shop that truth around and somebody likes it, but now they want you to come back and now you've got a whole new set of numbers. You need to be really savvy about having that conversation. You need to be honest about what the changes are and why they changed. But you need to have a real good explanation as to what that was, right? I didn't understand the market, or the market dynamics changed, right? Or my supplier slipped on me. I mean, you've got to really understand that, but you've got to just go in and just change your numbers. You've got to change the model. Sorry, who was first? I think I saw you first. Yes. I think it's wise to, I would say, put your plan in your own words. Start there. Make sure that you're comfortable with what you believe you're trying to do. So start there. And then I think that will lead into, as you're talking with people and getting that homework assignment that we talked about, that is where your assumptions will start to really resonate, and you can build your model out of that. Okay? Yes. That's a good question. You might become friends with Preston because he's got access to all kinds of data. I'm certain. But try try to go get as much free data as you can. And because you're right. I mean, let me say this. The data, you're going to have to strike a balance here because getting that data is pretty important. And, you know, if again, in our entrepreneurial spirit of going out and asking, that might be one of your first asks. I might need to get, you know, $1,000 to go get this report. And here's why I think that might be important, the way I want you to think about it. That data is key to you understanding if your model is really going to work, right? Have my client that invested in the hardware that was declining at 13% a year. Had we known that piece, that was a $20 million error. That he probably, had he bought the report we bought after he did his initial portfolio or product portfolio development, you know, 6 years later, when I first come on board and just helping him, that data would have answered that, right? $20 million wouldn't have gone away. So that's the kind of way you got to think about that. But there's a lot of free data out there. The only thing I'll say is some of those estimates are, you got to be careful about what you use. Let me say this, data is king, and you've got to weigh your cost on that. I mean, it's a valid point, but at some point, you need to ante up if you're out of school and get the right data. Yes, sir. Which one is going to get me to break even our money faster? Which model? I hear, and maybe my understanding, but it feels like that's a channel distribution kind of question. I don't know if that's the case or not, but you know, that to me is part of the research that you've got to go through to see what's the right fit. You know, tell me if this resonates. There are some models, there are some companies that you can go and create. You need a direct sales force. There are some where you can go and you don't have to go invest in actual people on your payroll, right? You just go to distributors or wholesalers, right? So very different cost structures, right? And I think it depends on what your space is. What's your widget? What are you selling? And the investment amount up front. You know, if you have to go build a big infrastructure and get a lot of salespeople, build collateral and all that, that price tag is very different than, you know, maybe half that same price. I can go and do, you know, 10 different distribution deals with 10 different big distributors across the country, the globe. And they get a cut of what they sell. You got to work that out. And I think that's part of that homework. That's part of how do I learn about my space and know, you know, what's out there. I think a great example is storage. Hardware, you know, you guys at UT, if you run an email and all that stuff, you're on somebody's storage server, right? The big guys that do storage, they don't have, they mostly do it through channel. They've got these direct sales experts that they bring in that kind of help manage the channel guys, but they want a large footprint. So if you're a startup and you're going into that space, you need to understand that, because if you're trying to go and grow a direct sales force, it's a lot of money versus I might need to go leverage these distributors. They know storage as well as anybody, and now this is what differentiates me. I can build that collateral and give it to them. They go sell it. Any other questions? If I didn't answer it or we're not clear, we can get time afterwards, and I'll be glad to talk with you more about it. Okay? Okay. I think we talked a lot of bit. This third bullet from the bottom, create a baseline case. That I think is important to kind of anchor yourself right? We talked about these ranges. I've got this ASP range. I've got these ranges. I don't know. The one thing that we'll know about your model, about how right it is, it's going to be wrong. It's going to be wrong, right? Because, you're making assumptions. Here's why I'm making them. So they're going to be wrong, but how do you get it? How do you get it to enough of a confidence level that when you go pitch it, you feel solid that this is what's going to happen? That's important for building credibility, right? Because again, you've got to come back into that room and you got to pitch again, show them the update, because if you need another round, they want to see credibility. So this gets back into that who. Who am I? How do you gain credibility? Once somebody gives you the check, you gain credibility by really going out and hitting those milestones you set for yourself. If you're developing product, you should have product development milestones. You're trying to negotiate contract, you should have negotiation milestones. The model interprets all of that. My product development is going to go from January through March. I'll need this amount of funding to pay my development team. Well, if you slide that out from March to May, did you account for the extra 2 months of payroll and everything else you need? That's cash burn. So the model is going to be, again, it's the interpretation of what's happening. So how do we get to that 90% confidence level? Not only do you want that for the investors, you want that for you. You want to be clear on, do I really think I can go hit this target? Do I need to how do you gauge that? That's up to the folks in the room and how aggressive do you want to be? I would just say that I've seen a lot of cases where folks are too aggressive up front. They believe that they're going to go into this thing and they want to get the money, so they're going to show a break even a lot sooner than reality. Those conversations are a lot worse to have than talking with somebody who's interested in investing in you about a longer break even period in the future. Coming back in afterwards and you were too aggressive, that's where it gets a little shaky. So again, build it, have those discussions. It's an iterative process here. Have somebody that's experienced. How does this look? Am I being realistic on my time frame? No, you're not. Okay? And it's okay. Just go back and redo it and come back and try it again. All right? Should I create a low scenario? What do you guys get what I'm saying there? You got this baseline of you're most likely, I'm pretty confident. What is my what if I miss case? What if I am having to slide it out by 6 months or something happens, I don't make a sale because I'm 3 months off? Should you build the low case? Why? What's the impact there? What do you want that for? Yep, exactly. Any other thoughts? Great answer there. Anyone else? I tied it back to cash. I want to know if I really screwed this up, how fast do I run out, and then when do I need to really start thinking about going to get more money? I think there's various good answers. You guys are definitely more polished than I am, but I think it's all about, again, it's that cash. When does my runway run out? You really have to know that, especially if you got people on payroll. The worst thing you can do when we're talking about building credibility is lose that in your own company because you couldn't meet payroll. CEOs get removed, startup CEOs get removed for not understanding that. You can have great product and everything, but you will quickly become a CTO or something else and not a CEO if you don't understand why you miss payroll. Okay? What about a high scenario? Any thoughts on that one? Build it? Why? What does it give you? There you go. What about from an investor standpoint? right? What if you came in and you're just talking most likely and you got this kind of, this kind of, it's all right profitability, but hey, you know what though? If I can pull these in and hit some home runs, that hockey stick, instead of being out in 5 years, I can get there in 3.5. That can be compelling. Might get you some more money up front too. Okay? Somebody had a hand up, I thought. Yep. Great synopsis. I think that what this should force you to do is to think about your ranges, right? So that you go into your conversation knowing all the knobs, and if I tweak this knob, that's what it'll impact. High, low. All right? What does it all mean? So you've got all these statements. I talked about P&L, profit and loss statement, income statement, a balance sheet. Not so much needed in terms of, for me, I think you can get a lot done with just the one statement. Let me just say that. You can get a lot done. You can have a great conversation with just a P&L. Okay? We'll get into a balance sheet and cash flows maybe in future conversation. The cash flow would be the one I would say is second important, just because that's going to, again, be that gauge for you on your cash runway. Okay? But you can still get some of that even on the P&L. There's an EBITDA line. There's earnings before interest, taxes, depreciation, amortization, EBITDA. That can be kind of a proxy for cash that is that's on the P&L. And so you can use that to kind of gauge how much funding you'll need. Again, in a future session, we can talk about differences between the cash flow statement and the P&L and balance sheet. They are all integrated. Okay, so not one of those really stands alone. We talked about pressure testing the model. I think that's important. That's also kind of that's your range. That gives you confidence. That tells you, what did we say earlier about typing up your business plan and, putting it in words? When you do the math and then you start pressure testing that, that's a great determiner of does the model work? I put a price out there of $5 for this product and it's, at 60% margins. Well, that sounds great on paper, but now, what if they come in and tell you that the market can only take 4? Do you have a way to get your margins back in cost? Claw back costs to get those margins rich. So you've got to kind of go through all that. And do your original set assumptions still hold? We talked about that. The what if scenarios. Just know your story and make sure it aligns with the numbers. The worst thing that I've seen is that somebody's pitching and they don't know, they got this great story, it's great, and it doesn't line up with the numbers. But they've got to really be linked. So you can't run from that one. Yes, sir. Yeah, I'm a big proponent of when you get started, you should, get QuickBooks. If you can get a bookkeeper, or if you need to learn QuickBooks to save dollars, you need to start, first off, just doing that. Taking care of your actual cost. Very important. But in terms of financial modeling and just kind of that future out there, again, depending upon how savvy you are in your understanding of the statements, you can do some good work on just the income statement. So again, if you're liberal arts and maybe let's say you don't take a business class, I know you're an English major, an income statement, a P&L, that'll get you a long way. And then you can go back and figure out, okay, well now how does that tie into my balance sheet and cash flow statement? So I think it depends on the maturity where you are. Before you go and pitch, if you're trying to go get money, you need to have all three of those together. You try to have all three. I've seen great conversations with just an income statement, but it works better if you've got all three. Okay? So don't let having all three stop you if somebody's saying, yeah, I want to talk to you about that idea. I think if you're pre-revenue, you should do a P&L, straight up. Okay? That P&L, that's going to tell your story. When you think you're going to start, when you start running expenses, right? Because even if you do a cash P&L, there you go. You've got in one, a P&L and a cash flow statement right there. Okay? So you can use that P&L again as pre-revenue to just get going and thinking about how long is it going to take me to get break even on cash. But one thing, I mean, think about it. Unless you're going out and getting big capital equipment where you're depreciating a bunch of stuff, everything else is likely just cash. Okay? Any questions on that? I want to make sure I don't lose anybody there on that conversation. Any good books or websites? I'm going to point, I don't know. I'm sure there's some good books or websites. I don't know if there's some resources that the university has. I'm sure there's some really good ones. You know, one that I remember, and it's been a minute, it's the 5-Day MBA. Has anybody read that? It's a good book. That's a good one. 5-Day MBA. He's a former MBA student. He basically took all his MBA, not that you guys that are MBA students aren't fantastic, but he boiled it into a great book. It's like 8 chapters of really good, relevant things. He talks about a lot of this stuff that I'm talking about. Okay? I think that first bullet is pretty important. If again, I talked earlier about cash being king. So profit a matter of opinion, cash is king. So profit gets into that depreciation conversation I had earlier, right? Where when you look at a corporation's books, that income statement, which can show profit, is not always telling you what you need to know about cash, because there are elements in the income statement that are non-cash elements, okay? So as a startup, keep it simple. Keep it simple, be smart about it. Make it as simple as you can with keep your eye on cash. Again, if you've got big pieces of equipment that you've got to go depreciate and different things, I would say still build you a cash-based model. That'll get a lot of answers. That'll get a lot of questions answered. And again, be upfront with whoever you're conversating about. This is on a cash basis. It's not accrual based. So you're not getting tied up on revenue recognition rules and all the stuff that you need to pay an accountant to come and help you with. Deal with that later. Talked about knowing your cash runway, funding between rounds. Anybody know what's a term sheet? I think I threw that out earlier. Does anybody know what that is? Okay. So a term sheet, when you get an investor, they are somebody that's interested in an acquisition or whatever the case is. They're going to give you the terms. Well, I'm going to give you this money, but here's what it means. The easy example is on Shark Tank, right? Who watches Shark Tank? When they make the offer, when Mark Cuban says, all right, I'll give you, $100,000 for 20% of your company. Well, that's the term. That's the offer. So that's his term sheet. Now, the real term sheet's got a lot more granularity in there. And you really need to understand what's in that term sheet. Okay? Again, this is the unfortunate side about working with VCs and private equity and this. Your model, again, you got a great model, you've done everything, you got the pitch. But let's say you miss the numbers. Let's say you miss it, right? And you valued the company at X, but now you got to go for a new round of funding. Yeah, we still like what you're doing, but this is a down round. So now all of a sudden, instead of you being a $20 million company, now you're 10. But I'll still give you $10 million to go build it up. But you know what? I'm going to dilute you a little more. We're going to get some warrants and other things to make sure we kind of get ourselves locked in. We're going to have a preferred class that's going to have all different kind of liquidation preferences and all that stuff. What does that mean? We're going to get our money first. You do start making money. Somebody buys your company for $50 million. I've got priority on the liquidation preference, so I'm going to get paid first. So that term sheet is important. Understanding your model and then how that connects to what you get offered is important because, again, you want to use your model to understand all aspects of this, of what you're getting offered. Why are you getting offered that? We can talk about that in the model. Cap table. Anybody know what a cap table is? Cap table is a capitalization table. Who owns the company? Right? So you're going as an entrepreneur, you're going to that cap table becomes vitally important to you. Talks about again who's diluting me, how much that is, that kind of thing. So am I running out? So we can go on and on. There's a lot of good other financial terms and different things that I could have added here, but those, when I was thinking, what are the ones that I think are important that you should at least go Google and understand? I would say look at those. Those are key. Okay? So, why is the model important? Know your numbers. Understand the impact. I'm sorry. So, cash is king. Really, guys, ask questions and get help. Hard for me to pitch all the good stuff in an hour, but seriously, ask questions and get help. I've got information here. I'll be, Preston, so happy to share that. Thank you. I'll leave it there. Q&A, or I'll open it up for questions if anybody's got any questions. I have. No, it's a different conversation because, of course, they're not investors per se, right? They're typically philanthropists, and so you need to have all those elements. What's your story and all that good stuff? And there's a set of financials, different set of financials than a commercial for-profit set of financials. But the elements, the key elements, mostly the same. And you need to understand for not-for-profit, again, if you're bringing staff on and those different things, you need to have that all mapped out anyway. So I wouldn't change a lot, okay? Any other? I think what's okay is it depends on what industry you're in. Different industries will have different investment levels and different product maturity levels. And so it depends. I've got some hardware, let's say semiconductor IT-related companies. They've got a longer runway because it just takes a while to build that muscle. And the investors know that. And so the key, I think, is really to match what you're doing to the right investor. Because they have time on their money, and you want to get the right time on your money. You don't want to go to a software-based, I'm looking for return in a year investment, and you got a hardware play. That's not going to work. They're going to be hounding you the next year, where's my money? You showed me break even, right? Versus if I go to some guys who have, or folk who have a longer time period, they're used to waiting for 3-5 years. So it really depends on the industry. So that's not like a direct answer, but that's really, I think, the right one. Any other questions? Thank you. Oh, there you go. Yeah. So a lot of times what happens, you get funded, right? Let's say this is a series. The first round after Angel Fund is called a Series A. So let's say somebody gives you that $10 million check. At some point, because you know your numbers, you're going to know that $10 million lasts me for 2 years. Well, in about a year and a half, you should have made enough milestones and different breakthroughs and different things so that you're already packaging for the next funding round, because in that 6 months, your 10 runs out. You better start trying to get that new check, so that's the new funding round. So sometimes if your primary investor likes what you're doing and wants to stay, they'll give you what they call a bridge loan. So your 2 years runs out, Well, then that next year, they'll keep funding you money. They'll keep giving you a loan, which will have terms on it, like in a term sheet, okay? And what it is, it's venture debt, and they've got terms on that debt. Like if you go to a bank and you go get a loan and get debt, like 10% interest, that kind of thing, that's what happens in the VC world or startup world. You'll get charged interest, but when the round closes, when you find another set of investors that want to close that round, that debt will get converted. They'll take the debt off your books and they'll make it equity. And there's a whole bunch of math that goes along with that. So you need to understand, though, what you want to understand is your runway, when do you start to go get the new money, and what are the terms on the money that they're going to give you before you get the new money. Does that answer your question? Okay. You won't get funded with that one. You won't get funded either. You need help.
That's true.
You need help. You need help.
All right, so we're going to close out. I want to thank you all for coming.
Thank you. Appreciate it.